You're listening to the Breakaway Wealth Podcast, the show that helps you build wealth faster, think outside the box, and break out of the herd. Here's your host, Jim Oliver.
Welcome back, Breakaway Wealth. I'm your host, Jim Oliver, and with me today, we're going to talk about one of my favorite or least favorite subjects, depending on what side of it we're on, Brett Swarts, and we're going to talk about tax flow. Welcome, Brett.
Jim Oliver, grateful to be here. Thanks for having me.
Absolutely. Okay. I love the name of your book, and it's Building a Capital Gains Tax Exit Plan.
Yes, sir.
Also has a podcast called the Build It to Billions and Capital Gains Tax Solution podcast. He's the host, and he's a real estate broker, also an expertise in real estate and Deferred Sales Trust, Delaware Statutory Trusts, 1031 exchanges. And he's the founder of Capital Gains Tax Solutions. Anything where it says tax and then there's a solution, Brett, I'm all for. So let's just get started. And he's teaching entrepreneurs just like you, audience, purpose-driven entrepreneurs how to build their capital gains tax exit plan. I went to public school, Brett, so just bear with me.
So did I.
So let's tell everybody, what does that all mean? Let's just start from there.
Yeah, what does it all mean? Well, I guess it really depends on what you're trying to solve. So if you've got a big, massive exit in Bitcoin business or real estate, you're facing likely 20 to 50% of your proceeds being taxed, especially in California or New York, New Jersey, Illinois, these bigger tax states. Even in Florida, where me and Mr. Jim Oliver reside, we're still getting hit with the federal 20%. Obamacare 3.8, so it's like 24% on most deals. So that's the big problem people are trying to solve for. And it's not just cap gains tax, it's also income tax deferral and finding vehicles in which tax flow is your focus, not just cash flow, is what we say if you can watching this on YouTube. My shirt that says that. And that's really the focus is how do you compound and multiply freedom and impact when you have a massive exit? It could be a primary home, it could be a business, it could be Bitcoin, it could be real estate. And you want to be able to compound and basically build a wealth team to help you execute on the next chapter of your life.
Awesome. Well, I have some companies that mine Bitcoin. And I'm not going to say whether I have Bitcoin or don't have Bitcoin because the IRS might be listening. No, I'm just kidding. I'm kidding, IRS. I always go right down the middle. So let's talk about just people's strategy with taxes. What do you see with most entrepreneurs? Is there a tax plan, or is it just kind of, oh my gosh, I mean, all I hear my friends do is complain when it hits them and they act like they didn't know it was coming.
Yeah, I think the biggest mistake is thinking that your CPA is a tax strategist when oftentimes they're just a tax reporter, right? They just kind of report the score, what happened the last year. And to be honest, like you can't blame them. A lot of them just get paid for doing tax returns, and that's what they're paid for. And they're just not, they don't have the level of expertise. No, they have the 10,000 hours studying the particular parts of the tax code. That's where we come in, right? And we really say, hey, find a tax strategist, a particular capital gains tax for your largest exit, because you're going to give 20 to 50% away in tax otherwise, right? And so you might as well, build that plan, build that team to execute. So that's, I think, one of the biggest mistakes. The other second is they assume they actually have the tax strategist, or they have the smartest tax guy or the smartest financial advisor. And oftentimes you go, okay, well, then maybe they would have already brought the solution to you. And that's part of the biggest thing that we come up against is we're constantly working with and saying, hey, we're going to add to your team, not replace your team, right? Unless you have B players. But if you already have A players, let's just add to the team, right? And let's find out a way, because otherwise you're going to get crushed with this tax. And this is going to be your biggest exit that you're ever going to face. Your financial legacy and the stewardship of the wealth is at stake. And that's where we like you said, we serve purpose-driven entrepreneurs. And what do they want? They want flexible strategies. They want truly passive income. They want the ability to run their own deals or be passive, retired or active, right? And that's where I think it separates us, is our strategy really gives people that ability to do all those things and invest into insurance and invest into stock market and invest into Bitcoin and real estate. Diversify. You don't have to be just one 1031 asset to another 1031, right? That's the challenge with the old blockbuster 1031. We offer the Netflix version. So I know that's kind of a bigger answer to your question, but those are some of the key things that I would start with.
No, and I like that. Okay, so let's talk about a conversation I had the other day driving to golf on Saturday. And this is a guy that I'm going to use round numbers. He bought his house for say $1 million, and it's worth like 3 million now. And he's like, you know what I told my wife? I told my wife we're going to sell this house and we're going to rent, and because the market's going to go down, and we're going to buy when the market's down. And so, what's wrong with that strategy, Brett? Because I was sitting there going, okay, you haven't thought that through.
Yeah, so it depends. Is it a primary home? Something's a primary home they're living in, right? Because
Yeah.
they're going to have to rent something out. And if they're living in Florida, you have what's called the 121 exclusion. You've lived there 2 of the last 5 years, or really any state actually. So if they bought it for $1 million, the real basis is actually 1.5 million. Okay, because they have that 121 exclusion if they lived there 2 of the last 5 years. So if you first thing you want to clarify is the tax. So 3 million minus 1.5 million, and that's not even counting closing costs, is 1.5 million. And on this scenario, you get about a 20%, about a $300,000 tax.
Yep.
You don't have Obamacare because it's a primary home. And so now I want to take that by the debt. Now, depending on what debt they have in place or not in place, we'll determine to see if it could be a decent fit. But so far, I'm only seeing about a $300,000 tax liability on a $3 million exit. Hypothetically, if they were free and clear, I don't think you would need our particular strategy because it's just the tax pain. Isn't the ratio is not strong enough to warrant ours. As far as the bigger strategy itself, I mean, I think your primary home is not an investment. So I think he's more thinking like investment mindset.
Yeah.
And your primary is not an investment. That's one of the bigger mistakes people make. I mean, or at least their mindset. I don't think that's what you want. And so, I mean, if you want to rent somewhere and you want to be somewhere else, then sure, go do that. But I wouldn't let the tax tail wag that primary home investment dog, if you will.
So, okay, let's mix up the scenario. Let's say I've got another friend who's has an offer on the table. It's really the particulars about how long he'd stay on, everything else. He's selling this business for just a little over 50 million, but we'll use 50 million for a round number. So he says, he's not seller financing it, anything. It's private equity, just gonna, according to him, I don't think this is how it works, but he says they're just gonna write him a check. And, I've never seen private equity just write a check, good luck, whatever. They normally it's some kind of earn out, hybrid, something. But if it was, just write him a check for $50 million. Let's talk about that scenario.
Yeah, when you're in that high of net worth, and depending if you're married or single, you're in what's called a death tax, estate tax challenge. The tiger by the tail is cap gains tax, but the elephant in the room is the death tax. And so one of the biggest mistakes people make is thinking that I can just hold on to my assets, get a stepped up basis, and my kids will have no tax. That's true for capital gains tax, but not true for estate tax. And so the first thing we want to clarify is, okay, Mr. $50 million seller, are you married? If he says yes, then that's a $30 million exemption right there. Second thing, if he says no, it's 15 million. So we already know he has an estate tax issue. I'd imagine his 50 million is not all of his net worth. He probably has more net worth. So we're going to want to consider that. So we want to take an inventory of what we're actually solving for, get really clear on the capital gains tax liability and the estate tax liability. Okay, so once you get clear on that, then you want to get clear on, well, what's your legacy for your wealth? Like what kind of impact do you want to make for your family? What kind of impact do you make for the community? How charitable minded are you? Are you going to use life insurance to offset some of that estate tax through some creative planning with Jim? Are you going to be using in other words, we need to do kind of a wealth assessment. Like anytime you have these big exits, you got to consider that. But now let's just break it all down. Let's just say he's worth $100 million just to keep it simple, right? And he's married. So now we got $30 million exemption. So the first thing I want to do is I'm going to propose a strategy that's going to eliminate this $50 million outside of his taxable estate. Let's say he's 60 years old. So he's got a lot of years left. And that 50 million we think is probably going to double every 5 to 7 years. You can do the math pretty quickly on that. Let's say he lives to 100 years old. Okay, so this 50 million is going to turn into a massive number, which means he has an estate tax, death tax issue for sure. And so our strategy, we're going to eliminate that estate tax in one day in one sale. And here's the cool part, Jim, without any charity, if you don't want to give to charity, although you can, it's optional, without any gifting, so it's not giving up any of the gifting, the lifetime exemption, and also without any life insurance required, okay? Here's the cool part, though. You can still partner with this trust and buy life insurance, which then the life insurance is no longer just an offset of the estate tax. It's actually a generational stewardship ability to make a huge impact for the family or for the causes you believe in most. And so it's called, I guess, having your cake and eating it too in this scenario. So we're going to exit. We're going to eliminate the estate tax on this 50 million. Okay. Number two, we're going to defer some cap gains tax, because the strategy, you can either have a stepped up basis or outside the taxable estate, but you can't have both. And then they're going to receive a payment over their lifetime, or they're going to pay tax slowly over time. So that's kind of the quick version of this.
Yeah.
That's our 2.0 version. It's, for massive exits above basically 20 million. And then we have a 1.0 version we could dive into, but let's focus on this 2.0 for a second. Any questions on what I just said right there?
I do have some questions, but go ahead, because I have some questions about when you're doing infinite banking, and the reason that I don't really like those policies to be in an ILET, because there's all kinds of restrictions. Even if you had like a SLAT or something like that, to where you could take loans, funding levels are low because of gifting, and then you have risk that somebody that you're gifting the money to doesn't, I've got 4 kids. I can't tell you all 4 of them are going to be reliable, and when they get that crummy letter, are going to be cool, right? And so that's a problem for me. But so based on what I just said, keep going, or you can answer or address any of that.
It's really massive what you bring up there, right? And this is where the flexibility and the adjustability are so important. A lot of the other strategies, the slats, the cruts, the crats, the mings, the dings, all of these different ones, they tend to be more in a box, okay? Kind of more restricted. And the biggest challenge for us, Jim, as entrepreneurs and your friend that you're talking about here, is we don't want to be put in a box, right? We want options, we want flexibility. With flexibility to give more to our children or give less to our children, to not have to gift it to kids, or be able to gift it to charity. And so having flexibility to adjust this over a period of time is really, really important. And so the beauty of our strategy, for those who are running what it is called a deferred sales trust, it's an installment sale with the trust. We have an irrevocable version, and we have just a business trust version. And we typically are using 1 or 2 trusts. It's been going around for close to 30 years, thousands of transactions. But why it serves the purpose of an entrepreneur and investor is because we want to be able to be nimble with our investments, nimble with our active versus or passive deals, right? And adjusting all of the time. Maybe a real life case story of this, a case study of this. Client Warren and Catherine owned a $2.5 million multifamily property. Their kids are 10 years old. They had kids older in life. And they're saying, Brett, we have millions and we have about 120,000 NOI, but Warren is spending all the time at the property, right? And he's trading his 3 T's, the toilets, trash, and the termites, for the 2 T's, his two twin daughters. In other words, he's having to choose on the weekends. And, Catherine's frustrated. Daughters want to hang out with dad and mom, but dad's having to get pulled to the property. Now, the property was a great property. Good tenants, actually. Good location. And part of Warren and Catherine's heart used to be with the property and taking care of the tenants. But they're looking at these 2 things and go, we got about an 8-year time period. 85% of our time with our kids, Jim, is spent before they're 18 years old. Right. And they're going, we want to spend time with our kids right now. And so it's really simple. We sold the property. We deferred all the capital gains tax. And the problem was they didn't want to trade 15 problems for 30 problems. Right. They had 15 units. They didn't need 30 units. Right? They didn't need more millions. They needed time back. They needed truly passive income. And so we set up a plan that allowed them to exit, defer their tax, pay off their debt, get liquidity, get diversification, and get what's called truly passive income, where we call that no shoes, no shirt, no problem. Jim, you're Kenny Chesney playing your guitar on the beach, and you got the waves coming in over here, you got the wind blowing over here, and you got this consistent income just coming in every single month. That's durable, that's passive, that's truly passive. You're not trading any of your time for the dollars or your stress, and it changed their life. It gave transformational outcomes for families, and that's really the big piece here. It's like, does Warren and Catherine, do they want to be active again? I think they will. I think once their kids are 18, or watch this, the kids go to 18, they go to college, then they're done at 22. Well, maybe they want to partner with mom and dad. Well, guess what our trust can do? It can partner with the kids, right? And do the next business or real estate deal or whatever. Like, that's really cool. The funds can go into Bitcoin. The funds can go into life insurance. The funds can go into the stock market in the meantime, or whatever, everything in between. It's nimble, it's flexible, and it solves what they really want, which is right now truly passive income, and then the ability to be truly an entrepreneur later on if they want to be again. So that's the key. Like, we're in the world of AI, automation, change, and adaptability. You've got to have a capital gains tax solutions plan that gives you all of those.
So I love that. I love what you said about AI, by the way, because I think bookkeeping is about ready to be a thing of the past. Having a bookkeeper I think it's already here. I just haven't found the right solution for that, and you might have it, but you don't really need to pay somebody an hourly wage to do bookkeeping when you have a credit card and QuickBooks and AI. And that's okay, right? Because when I agree with you with the CPAs, and I'm not knocking CPAs. We got some great CPAs as clients, and we got some great CPAs as in the audience. But what I see from CPAs is there are CPAs that they're black and white, fill out the form, here you go, right? And if you bring them an innovative idea, they're like, well, no. Well, if that doesn't work, then you're going to fire me. So I'm going to say, don't do that. And I've had people on here that say they're tax strategists, and they start talking about 401ks and 529 plans and IRAs and self-directed IRAs and all this crap. And I'm 100% against any kind of qualified plan because the government anytime the government's in control. And so I love that you're not talking about any of those things. And like, well, here's how you say it. I'm not talking about the herd. If you're an entrepreneur, if you're a real estate investor, you're not in the herd, right? You're out of the rat race, as Robert Kiyosaki would say, or you're trying to get out of the rat race. And so when you think of these tax strategies, audience, like if you listen, I listen to details. Every question I've asked Brett, there's no hesitation. He knows the answer. Boom, 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 boom. It's not revocation of election. Here's what I'm going to do. You're not going to now never tell a cop that your name is James Oliver and you'll be fine. I don't want to go to jail, Brett, and so I'm not going to do that revocation of election. I know somebody went to jail for that. Or I've heard, I know somebody who knows somebody, and I don't want to do that. I understand about setting this trust up and this trust up and this trust. I want to minimize taxes without going to jail. Is that fair?
Oh, yeah. Yeah, I love everything. By the way, I love all that. By the way, I also got rid of basically all the 401ks, the IRAs. I just said, get me out, because I don't want to wait till a certain age to have this freedom, of time. I don't want to wait to have to, these restrictions. So I'm with you on that. And each of those have their place. But most of the entrepreneurs we work with, they're worth $5 to $100 million, right? And they're looking to make an impact and a difference and have freedom on a different level. So I think, number one, I'll get into the legality of what we do and our track record and such. But I want to go back to this thought of TPI, truly passive income, right? We believe that truly passive income is to your freedom and impact as compounding interest is to your money. And that the biggest thing that you can do as an entrepreneur if you're exiting is figuring out, is it $10, $20, $30, $40, $50,000 per month? And how do you convert your exit that's consuming all of your time for maybe decades, right, to a truly passive income compounding, not only increase your cash on cash return, if you will, but free up your time, right? And give you security, give you peace of mind, give you flexibility. So truly passive income is to your freedom and impact as compounding interest to your money. And when you focus like a laser on achieving that, it's incredible what it can do for you and your family, and also for the most vulnerable people, the MVPs, right? Make a difference for the things you believe in. And so now back to the legality. Yeah. So on our strategy, it's really important to have what's called certainty of conviction when it comes to not only your team is going to execute this, but the strategy's actual legal IRS, what happened on the audits, right? So first of all, here's 7, I don't have much time to go through all 7 questions, but there's 7 questions you should ask of every single tax deferral strategy, at least, the ones that are capital gains tax, large exits kind of things that are going to get, likely to get audited. By the way, every single tax strategy works, Jim, every single one of them, until you get audited. Okay.
Yep.
Okay. So there's 7 questions. Number 1, how many audits have you been through, right? Now, our strategy, it's been over 30 audits. With how many transactions have you done? For our strategy, it's been thousands of transactions. We actually have a very low audit rate. Now, of those audits, what was the outcome? Our outcomes have been no change, no findings. So are you batting 1,000 with the IRS? Wow. Yes. Have any of the people who have, used your strategy, had a failure on an audit? No. Okay. No findings, no failures, no changes on all of the audits. Okay. We fully report everything. So back to the legal part, like we're fully, how do you report it? It's reported on typically one page, which is an installment sale reporting. Simple. Okay. Of the audits, who defended the audit? So I work with the tax attorney, a CPA, who's a genius. He's the one who's all about all of the audits, lifetime audit defense, which is another question. Do you have lifetime audit defense? We do. Right. So all of these things are built in. And so we're not guessing at this, Jim. We're not saying, hey, Jim, give us a shot at this. We'll see if it works for you. And we haven't done just a handful for, this is decades. This is close to 30 years. This is thousands and thousands and thousands of transactions, billions and billions and billions of assets sold using it. The reality is most people don't know how to do it. They don't have the team that knows how to do it. They don't have the basically compliance team. Our role is a trustee, right? Who are the people that are working? There's a trustee, there's a tax attorney, there's the seller who becomes the note holder. Understanding those roles. We work with financial advisors. If you want to, we can, or you don't have to. And it's this ecosystem within this structure of an installment sale with a trust that opens up the flexibility, because we're doing an installment sale versus just funding something or gifting something, right? Or transferring something. It's a sale. There's a third-party buyer. So I'll bring this to life, right? We just did an $8 million sale in Massachusetts for a couple, and they were selling their automotive shop. And actually, they took it from 100,000 of revenue to multiple millions in revenue. And so they sold like a 60% of the shop, and then we deferred like $2.5 million of tax. But they unlocked all of this time, all this diversification. Now they have a passive income stream coming in, right? This is the transformation for them. They have this extra $2.5 million working for them every day in these investments, and it's compounding. And the neat part is it's basically a zero interest loan from the government. The government says, hey, as long as you sold for $8 million to the trust, and the trust sold it for $8 million to the buyer, and the trust issued you a promissory note for $8 million. In this scenario, the seller has a zero gain at the time of sale, because they haven't taken any. They had an $8 million time of sale, but they have zero constructive receipt at time of sale. So then a deferral state, and we write an interest rate, I think, of 10% on the note. So you do the math on that, right? And then we go invest the funds to try to earn that. And then they only have to live off the interest or partial interest payments. And they get to compound what they would have paid in tax. And the government allows you, for up to the first 10 million of a married couple, to have zero interest charge on any of that $2.5 million. So think about that, Jim. $2.5 million at 10%, that's an extra $210,000 per year, right? Yeah. And then you look at that compounding effect for that over your lifetime, it's massive. Plus, they live in Massachusetts, and so they don't need all of that $800,000 per year. In fact, they only need a portion of that. They get the compounding effect of the income tax deferral, kind of like an IRA, which is actually a good thing when you have an IRA for that purpose. And so that is what we're building, is a tax flow mindset with cash flow mindset, and combining that with the strategy that gives you the freedom and flexibility to execute on your investments.
I love that. The thing that I try to help people understand when we tell people about infinite banking, and we talk about your need for finance over your lifetime is greater than your need for investment. But I start to think about something. You earn $1, and forget about whether you're in California or New York. And I love how you said California. Would you say
Taxifornia? Yeah,
Taxifornia. I love that. Is let's say you made, just say $1, right? You're going to pay around 35% of that in volume of interest, right? Meaning, or actually of your net dollar. First, you're going to pay taxes. State, local, everything else. But let's just say it's whatever percent you want to use, 30%. Okay, let's just say it. So you got 70 cents left. Now you're going to pay 35% of that, around that, to volume of interest, not interest rate, but volume of interest, the actual amount of interest. So because of your mortgage, really, right? Your mortgage, your cars, and everybody finances all this crap. And then you're going to, so you just paid, so you paid 30% tax. You paid 35.5% to the banks. So you paid the government, you paid the banks, and then what are you going to do? You're going to save a little bit in Wall Street, and they're going to take fees and expenses and everything else. And then you're going to try to save, with that money, 10% of what you make, which is a lot. So you make $1 and you're trying to save 10 cents of it. That makes no sense to me. When if I could cut my tax liability in half, I just had a 50% increase in my money that I was going to try to save, which I'm not, right? Talk about what you see when people really, my mentor, Nelson Nash, would always say, Brett, he would say, if you understand what's happening, then you'll know what to do. And this is what I'm trying to wrap this up to, where if you are one of these people, would you say $5 million to $100 million net worth? There's a lot of people in this audience that fall right in that. I'm thinking of 3 right now that own multiple businesses. And so comment on what I just said, and then let's talk about how you work with your clients.
Yeah, I think you're speaking about the power of compounding interest, or the opportunity cost of not compounding your interest is really what you're saying here. And like, having a tax flow versus just cash flow mindset, and understanding. And also, you also mentioned debt flow, and I call it, it's actually a 3D mindset you're talking about here. So you have cash flow, which most people stay in. That's all the world they stay in. You have tax flow, which we're trying to get into, especially capital gains tax flow. And then you have what's called debt flow. And you have this is like, Ray Dalio says it well, like, so pain plus reflection equals progress, right? And so what are some of the pains we've had? The 2008 crash, friends, family, clients of mine, and tax attorney lost half or all of their wealth because they're doing these 1031 exchanges. They're overpaying. They're not diversified. They're not liquid. They're in too much debt. They think that the merry-go-round of this 1031 is always going to be the end to this wealth building, stepped up basis is kind of the thing. And by the way, I'm a California real estate broker by trade. I grew up building real estate with my family in the Bay Area. I sold at Marcus and Millichap. I've done lots of 1031 exchanges. So I get it, right? Like there's that world, but think about it for a second, right? If all of your eggs are in just one asset and one location and one place, and you're just trading these units over and over, eventually the music stops and you get caught. And this is what's happening right now. Multifamily is getting crushed by a lot of people who overpaid when interest rates are high. Everyone knew or interest rates were low, and the tax stuff benefits were just 100% bonus back a few years ago. Now it's back again, and it drove an artificially inflated real estate multifamily market. You had double-digit rent increases over year for certain places. It was crazy, and all of a sudden you're surprised when the market shifts. Well, we weren't surprised. We told people to get out because in 2008, we saw the same thing. In fact, I had a client, he was going to be a client, but he went bankrupt. He had $50 million in multifamily property. He was over-leveraged, and I met with him in 2007 before I knew our strategy. And I said, Steve, we should sell your property. He goes, Brett, here's the problem. If I sell, I can't really afford the properties because they're too high. 2, I don't know if I can get the debt anymore because I'm over-levered. And 3, I don't want to be forced into a shotgun wedding running around with my hair on fire on these 1031 exchanges. And so I'm just going to stay where I'm at. Over the next 3 years, he lost every single one of his properties, went bankrupt, lost his marriage, and he had two sons, right? And now all of a sudden, he's not spending any time with his kids like he wanted to. And so what did he really achieve? Maybe not much, right? That's the sad part about it, right? Now, could our strategy have helped him? Maybe, right? Could we have got him out of debt? For sure. Could we have diversified his wealth? Absolutely. Had I known about it, but I didn't know about it until the 2009. And so what you don't know, is the number one most expensive thing. Number 2 is taxes. And so all of these things need to be talked about. And if you don't have a team talking about them, and then it's going to be very hard for you to achieve what matters most to you, which kind of will end with this, right? What matters the most to you at this time? Not what matters, but what matters the most. And when you get really clear on what matters the most, and most people want truly passive income. They want diversification. They want liquidity. They want the ability to invest on their own terms, right? And that's what you want to find. The people who are built it already, who have the playbook. And hopefully that answers the question, Jim.
No, it does answer my question. All right. So if you're sitting in the audience and you're not intrigued and you don't want to call Brett and go watch his YouTube stuff and go to his website and learn more, then you weren't listening. So
then rewind and watch it again. Yeah.
Yeah. Rewind and watch again. I'm a slow learner, so I understand. But Brett, tell people how to find you. What's the best way to start? Because I think sometimes people don't want to take action because they think, well, I don't even know what I'd ask Brett. I don't know. Right. I guess I fall in that scenario, but I don't really know. I don't have a buyer. I don't know when do I plan. They don't know what to ask. They don't know what they don't know. Right. Yep. So how do they get a little bit of education and then they decide to engage with you?
Yeah, first of all, we call it the pressure-free, no obligation consultation kind of thing, right? And so, first of all, we'll never talk you into something you don't think it's a good fit. Number 2, we don't even charge anything unless you close. So if you don't close on your deal or you don't want to use the strategy, no problem. We don't charge anything. So everything is 100% conditional. That includes the tax attorneys, setting up the trust, talking with your M&A advisors, your business brokers, your people, your CPA, literally all of it, A to Z. We are so confident in what we do. If we can spend just a couple hours with you and your advisors, that you're going to say yes to us. And so we don't charge anything at all for all of that. Okay. So that takes all that pressure off of that. I think the biggest thing is, people, you need to start. The best way to start is to build a capital gains tax exit plan. In fact, we wrote the book on it, Building a Capital Gains Tax Exit Planning. And you spent 5, 10, 15, 20 years building your business or real estate or investments. And if you spend just 5 hours with us, it's really simple. 1 hour consultation, 1 hour with our legal team, 1 hour with a proposal, talking 1 hour with our clients. You want to read the book, come to one of our live events. We have a very high close ratio, and likely you can be a great fit. And so that's what I would say. Pick up the book, go to capitalgainstaxsolutions.com, apply for a no-cost consultation. Here's the key: to have at least $1 million net proceeds, $1 million gain for the transaction. So these are bigger deals, guys and gals that are listening. So make sure it's large enough. Now, if you're a real estate professional or financial advisor, insurance professional, CPA, we also want to encourage you to look at our service for your clients and get, offer it as a referral, right? To help build your business. It's a nice way to build a business. And the very last thing is 1031 exchanges. We will still help you with that, okay? In fact, there's times, Jim, where we're using a partial 1031 and a partial deferred sales trust, okay? A partial Delaware Statutory Trust, 1031, and a partial deferred sales trust. So you can do all three. So sometimes the hammer is needed. Sometimes it's a screwdriver. Like, you've got to know that there's multiple strategies. Sometimes we're just doing cost seg bonus depreciation. So think of us like your capital gains tax AI super agent for your next exit. We're going to either connect you with the best party to execute on these different strategies, or we're going to go all in on our deferred sales trust strategy for you to execute. Does that make sense?
Absolutely makes sense. And if you go to capitalgainstaxsolutions.com, there's all kinds of information on here. I looked at it earlier and I just pulled it back up. I mean, you've got just some great stuff on here. I mean, like the resources. I mean, there's courses, estate and wealth tax planning. I mean, save taxes. Don't take risk in an investment. Don't go, well, gosh, I gotta make money. I gotta do this. I mean, save your taxes and do something. And you have a mastermind and there's courses. And when you go to these masterminds, especially when there's a strategy like this, you're going to learn more and more and more. And I think even if you're buying a business, I could see where this is important, like on the front end of buying the business. So, I mean, like, anyway, that's, so anyway, go to the website. We'll put all of the contacts and everything in the show notes, audience, so you can get a hold of Brett. And, that shows confidence. I always love Alex Hormozi's book where he says, make offers so great that people feel silly for saying no, right? He says stupid, but I don't like to call somebody stupid.
Yeah.
So, you feel stupid for saying no. Well, he's saying this is all free. So if you're in this position, why wouldn't you make that phone call? All right, Brett, you obviously are a smart guy. You've done a lot of things in your career. What's the best advice anybody's ever given you?
Yeah, I think it's by Jim Rohn. He says, learn to work harder on yourself than you do on your job. If you work hard on your job, you'll make a living. You work harder on yourself, you'll make a fortune. And I think that helped to change my focus as I got out of college. I played college basketball and scholarship, and I had that career Marcus and Miller chat, but I never really focused on like the personal development and leadership side in a very intentional way. And so reading The Seasons of Life, in listening to Jim Rohn and remember when he said that, it really just stuck with me. And the whole idea here is, when you work for things on your job, it tends to be more temporary, but if you work harder on yourself, it tends to be eternal, right? And so it's character, it's leadership, personal development, it's your faith, it's your finances. I mean, it's mixed, but those things are the things that are going to matter the most, especially for the legacy and the eternal impact. So work harder on yourself than you do on your job, and you'll make a fortune.
I love that. When I was, I grew up in poverty. I grew up in Southern California, in Inglewood. I've been to Northern California a few times. I had a friend that lived in San Mateo, and I think Northern California, I've driven Highway 1 all the way up there. It's probably the prettiest state in the world. You can have it because I don't want it, but if God snapped his fingers and all of a sudden it was a different environment, I would love to live in California again. But I'll stay in Florida where, it might be a little stickier, but it's still beautiful too. But something you said, when I was in my 20s, I fought all of this stuff because I heard like it was pinned as motivational speakers to me, Jim Rohn and, Tony Robbins, all these things. And I'd go, I don't need motivated. I'm motivated. I've been homeless. I'm motivated, right? Like I don't need motivation. I don't need to be pumped up. But then when I realized that it was personal development kind of in my later 20s, that's when my trajectory went like that. And I think that what you just said makes sense across everything in your life. Because when you get to that point where it's like, and I remember sitting down with clients and they'd say, hey, we have $50 million, so we want to make sure we don't run out of money. And I'm like, if you run out of money, something's wrong. Okay. It's like somebody ripped you off, right? So like once you figure out whether you're 40, 30, 60, and you figure out I can't run out of money, guess what you start to do? Start taking care of your health. You start taking care of your spirituality. You start taking care of your faith. You start giving back to people. And, you know, being wealthy is a responsibility. If anybody's ever read The Science of Getting Rich, Walter Wattles, he says being poor is selfish. You can't have impact on anybody when you're poor. So if you're wealthy out there, save on your taxes, compound your money, get cash flow and tax flow. All right, last question, Brett. Before I get back, I almost got back on the horse to go right back into our tax discussion. But if God came down from heaven and only allowed you to receive or retain the knowledge that you've received from one book, what would that book be?
I mean, the Bible. I mean, can I say the Bible? I mean, that's
you can say the Bible, but then,
yeah.
Okay, now there's a follow-up question. What book in the Bible?
Yeah, so the Hebrews. So if you never read the book of Hebrews, it's if I had to pick one book, it's the number one book, and it's so rich, and with history, with theology, with exhortation, with beauty, with all of the things. It's an amazing book. So the book of Hebrews.
I love it. And here's the thing that I love that you said, the Bible. And I used to say other than the Bible, but I don't want somebody to say that, because I would tell you that every concept in personal development is in the Bible. Every concept.
100%.
And you want to talk about manifestation, and all, it's in the Bible. We don't manifest stuff. God manifests stuff. And that's in my belief system. You might, and the audience might not believe that, but that's if you look in the Bible, if you took everything, if you took Think and Grow Rich, you take all of those books, you will find the roots in the Bible. In fact, Nick Costco, my business partner, and we are writing a book, and it's the 12 most important personal development lessons of all time, and where you find their roots in the Bible. And so I love that you said Hebrews, and I'm part of a men's devotional we do every morning, and we've got like 15 to 20 guys. Something that bounces around a little bit, but we have 15 to 20 guys that we get up first thing, we read our devotional, we make comments, and it's just like that iron sharpens iron. So I love your answer. Well, Brett, thank you so much for being on the show and sharing this. I'm telling you, I'm going to go read. There's so much information on his website, and I'm going to go check it out. I mean, you're giving away a lot of good information. That's always the sign of somebody that knows. Hey, the more you know, this is what I tell people about infinite banking. I'm going to just educate you until you say, this is for me or this is not for me. And I don't care which one you decide, right? But my job is just to educate you. So when I look at your website and I look at all of this, you're educating somebody to where they go, hey, you know what? I got to call Brett.
Jim, I mean, thank you for having me on the show. Thank you for the opportunity to share. And yeah, I appreciate the opportunity to be here.
Absolutely. All right, audience, we're going to wrap this up like we do always with the great, incredible words of Earl Nightingale and The Strangest Secret, because you are what you think.
Here's the key to success and the key to failure. We become what we think about. Now let me say that again. We become what we think about.
Thanks for listening to the Breakaway Wealth Podcast. Be sure to subscribe to this show wherever you're listening so you never miss an episode. If you want to start increasing your wealth building ability right now, go to community.createtailwind.com to join our free online community and get access to free, in-depth training designed to help you build real, lasting wealth. See you next week.